Hello, everyone. Welcome to episode 1 of 10-Minute Bookkeeping. Have you ever tried starting your learning journey from the grand finale? Well, guess what? Today's the day. We're diving into our learning adventure with financial statements, the ultimate product of bookkeeping. You might have heard about the 4 main types of financial statements: the balance sheet, the income statement, the statement of equity, and the statement of cash flows. But hold on to your hats. In this episode, we're focusing on the first 3 ones, and they'll cover all the essentials we need to kick things off. So no more beating around the bush, let's jump right in. Imagine a balance sheet as a quick snapshot of an entity, frozen in time like a photograph. But this isn't your ordinary picture. It's all about the dollars and cents of the entity. An entity could be a well-known business, a government agency, a local church, or even a college. Yes, it's that versatile. This is what a balance sheet typically looks like. When you dive into a balance sheet, the first thing that grabs your attention should be its title, because it tells the general information. For example, this balance sheet is all about the entity called Pineapple Company, and it's current as of the end of 2022. You might also notice a little note saying dollar in thousands. Don't worry, it's not trying to make things complicated. It just means that all the numbers are reported in thousands of dollars. So when you see cash with a $140, it's really $140,000. Pretty neat, right? Now, let's break down the balance sheet lingo and explore its 3 main players: assets, liabilities, and equity. They tell us 2 aspects of an entity: what an entity owns and what it owes. Let's break this further. Assets are items of value an entity owns. To count as an asset in accounting, an item must pass 2 tests. The first one is that the item must be controlled by an entity. Usually, it means the entity must own the item. For example, if Company A rents a building from Company B, the building is not an asset of Company A, but it's an asset of Company B. The second one is that the item must be valuable to an entity. It means the item can bring some economic benefits to the entity. For example, a supermarket has some dairy products. Some are held for sale and some are expired. Those held for sale are assets to the supermarket. But the expired ones are not, because they can't be sold to customers and bring benefits to the supermarket. Now let's uncover the sources of these valuable assets. First up, we have liabilities: what others lend to the entity or what the entity owes to others. These others are often called creditors because they've extended credit and given a lending hand to the entity. The term payable covers various liabilities, such as salaries payable to employees, accounts payable to suppliers, loans payable to banks, or taxes payable to the government. The second source of assets is equity, the investment from the owners of an entity. It comes in 2 flavors: paid-in capital, symbolizing the owner's initial investment, and retained earnings, indicating the reinvestment of earnings by the owners. Let's go a bit deeper into this. Essentially, what a business earns belongs to its owners. Owners can choose to take out these earnings for personal use or put them back into the entity for growth. Retained earnings specifically represent those earnings kept within the entity for future use. Now, here's the magic formula: assets always equal liabilities plus equity. It's the nucleus of every balance sheet, earning its name as a balance sheet. Both sides of this equation are like 2 sides of the same coin. One side reveals what items an entity owns, and the other side tells us who have furnished those items, whether it's creditors or its owners. No matter which side you're looking at, it all boils down to the same thing, and they always balance out. For instance, take a look at the Pineapple Company's balance sheet. At the end of 2022, the company got valuable items totaling $1,720,000. Of that, $980,000 was from its creditors, and $740,000 was from its owners. The balance between assets, liabilities, and equity is the core of bookkeeping. So hit pause for a moment and try your hand at a little practice. Great job! You've just completed your first accounting exercise. Have you got all the answers? I'm sure now you've gotten familiar with the balance sheet. So let's move on to the next financial statement, the income statement. Reading an income statement is similar to watching a video that reveals how a company earned money during a specific time period. This period is known as the accounting period. For most entities, this period spans a traditional fiscal year, which is a 12-month financial reporting marathon. However, some entities might need more frequent updates and prepare income statements for shorter duration. The choice of the accounting period significantly impacts financial reporting. So when you're looking at an income statement, always make sure to check the period it covers. Now, let's take a look at an actual income statement. The title of this income statement indicates that it presents the financial performance of the Pineapple Company for the year 2022. This means all the numbers and data are specifically for the year 2022 and don't include any information from previous years. By keeping this accounting period concept in mind, you'll have a more accurate understanding of all the other income statements you come across. Now, let's talk about the key terms of the income statement: revenues, expenses, and net income. Revenues represent the inflow of resources resulting from an entity's operations over a specific period. It's important to note that revenues are not limited to cash. They can be any valuable resource that adds to the entity's wealth. Expenses, on the other hand, represent the outflow of resources required to generate these revenues. Similar to revenues, expenses can take various forms and reduce the entity's wealth. Net income, often referred to as the bottom line, is the outcome of all these financial operations. You can calculate it by subtracting expenses from revenues. For instance, according to Pineapple's income statement, the company garnered a total revenue of $670,000 and faced expenses amounting to $596,000 in 2022. Consequently, the net income turned out to be $74,000. Where would the net income go? Well, the coming section will tell you about it. Net income can either be saved up or shared with owners through dividends. The difference between net income and dividends is known as retained earnings. Now, for a fun challenge. We know Pineapple's net income for 2022 was $74,000. And if they paid out $20,000 in dividends that year, could you figure out their retained earnings? Go ahead and pause the video and give it a shot. Welcome back. The retained earnings for 2022 amounts to $54,000. But here's where things get intriguing. It doesn't quite match the retained earnings you'll find on its balance sheet. What's the deal? Well, here's the why. The retained earnings on the balance sheet showcase the entire history. All the retained earnings collected since Pineapple Company set sail. Let's say Pineapple began in 2020. The balance sheet's retained earnings are a sum of 3 years. However, the net income and dividends we just discussed were specific to 2022. So the ones we calculated are for that year. Just a portion of the retained earnings on the balance sheet. Actually, there is another statement that tells this story. It's called a statement of equity. In Pineapple's 2022 statement of equity, retained earnings began at $186,000, added $74,000 of net income, subtracted $20,000 of dividends, and then it became $240,000, perfectly matching the one on the balance sheet. Now you can see how the income statement and balance sheet are connected. The statement of equity is the bridge between them. As we've navigated the details of financial statements, let's distill the 6 fundamental elements of bookkeeping. These 6 fundamental elements are 1. Assets, items an entity owns. 2. Liabilities, obligations or debts owed to creditors. 3. Equity, investment from owners. 4. Revenues, total amounts the entity earns during an accounting period. 5. Expenses, what the entity spends for making those revenues. 6. Dividends, what owners get back from the entity. But how do these elements come together to tell the whole financial story? Well, it's a story of origin and sourcing. An entity's assets come from two primary sources: liabilities and equity. Equity further stems from both owners' initial capital and retained earnings. These retained earnings evolve from the cumulative differences between net income and dividends. And net income? It's the result of subtracting expenses from revenues. And there you have it, the full picture of the modern accounting language. If you didn't catch all the points, no worries. We all have to start somewhere. The journey might have a few bumps, especially in the beginning. But trust me, it gets smoother as you go along. So complete the practice, take a good rest, and return refreshed for more bookkeeping adventures.